Second. Oh, I'm live. Perfect. Hello, Dwayne. How are you? So, Michael, are you in Salt Lake City? How's the weather?
Yeah, in Salt Lake City. Weather's good. It's perfect 75 degrees today.
Nice.
At least I think that's what it is. I've been in my office all day. So when I go out, I'll find out for sure.
Good. Good. Uh, let's see. People are joining in. It's good. We have a lot of ground to cover today, Mike. So we're gonna be try to be mindful of time. Right? Make sure
Great.
there's a lot of interesting stuff to cover today. Usually there are a lot of familiar names and faces that you're gonna came across that you have chatted with. I've chatted with certain
Oh,
point.
good. Okay.
Yeah. So we we have a lot of fan base. So you have a lot of fan base, maybe. So yeah, you'll see some familiar names.
Cool.
Thank you everyone for joining. I think there's 1 minute left. We'll give another minute or two for everyone to join in, and then we'll start. Um, Michael, have you shifted to paddle, or you're playing tennis these days? Or are you part of that transition or not?
I'm still tennis. Yeah, still getting my butt kicked in tennis as recently as this morning. So haven't made the switch to paddle.
It's a it was, I don't know, maybe I just realized it, but it's been a massive transition. It's,
Are, are you? So you play paddle?
no, I don't play tennis. I don't play paddle. I've seen the
Ah,
transition. I'm thinking if I should start with paddle. I think it's relatively,
yeah.
maybe it's easier, maybe it's my word, but
Yeah, I've
uh,
I've noticed all the tennis courts are being taken over by pickleball. So that's
oh,
the thing happening here, at least in the states.
perfect. I think we're going to give another minute or two for people. I think we're on clock. We're going to give a minute or two for people to join in, and then we'll get started.
Great.
Um, perfect. Few more seconds, and we'll be good to go. Um, I think we should kick off. Uh, so, thank you so much, everyone, for joining another Valor's webinar. Today, we'll be talking about solar investment tax credits. We'll be going in depth in terms of a couple of things here: partnership structure, economics, how individuals like yourself would be able to claim all these tax credits and depreciation. And there are some hot topics related to political climate, where the wind is blowing in terms of the regulation, particularly on solar investment tax credits and the timing of it. We'll cover the agenda. But again, thank you so much for taking the time. Love to walk you through this whole structure. So I'm sure a lot of people are have chatted with me, talked to me at a certain point, about some of the products that we offer here at Valor. But those of you who don't know me, my name is Farhan Akhtar. I'm the head of ordinary income planning here at Valor. Been with Valor for 2.5 years now. I've done a bunch of these webinars, usually on the other side of the table, but excited to be on this side now, and very excited about today's webinar. We have a special guest today, Michael Pacada, who is with a company called Solar Powered Equity. Solar Powered Equities are key developer partner. We offer smaller residential projects in collaboration with them. Last year, we did more than 300, maybe closer to 400 projects with SPE, and that number is going to be easily around minimum 1,500 this year. And that's because of the increased demand, a lot of other stuff. More on Michael's company introduction and himself, but thank you so much, Michael, for joining today. I know you are a very busy man, a very tight schedule, but really excited to have you, and thank you again for joining.
Yeah, thank you. Thank you.
So before I'll give the floor to Michael for introduction about himself and company, very quickly we're going to walk you through the agenda of today's webinar. The topics I will be covering is the first, the relationship between Valor and SPE, how we make these projects accessible to our marketplace. We're also going to cover the solar tax equity partnership, the structure that we are highly focused on. Why is that attractive structure? Why not other structures that are out there, right? There are a bunch of them. What are the tax incentives and how they actually flow through you personally, right? How the entity is structured, how the partnership itself is structured, and is beneficial for you and for SPE. We'll cover the type of the projects. We'll cover a real life case study, right? And two hot topics. One is the political landscape, right? With this new one big beautiful tax bill. We'll cover again, nothing is definitive. Everyone knows politics is highly unpredictable, volatile, but we'll give our opinions in terms of where we think the policy is shifting and what would the future will hold for us. And the last thing that a question that I get a lot is about timing, right? How, when should we pull trigger on this? Earlier in the year, later in the year, what is the perfect time? What is the right time? And I think we'll cover that in today's webinar. Um, Very quickly, I'm sure most of you know what Valor does, but very quickly, Valor is a technology-driven company. We provide tax mitigation solutions that traditionally been available to ultra high net worth individuals and family offices. We have solutions on ordinary income, realized versus unrealized, and estate planning products. Is a portfolio of products that we offer on the estate planning side of things. We have a lot of content calculators on all the solutions that we offer, and so people can see the qualitative and quantitative benefits if they choose a strategy. So feel free to schedule a call with us if any of our products. Feel free to explore our website. If any of our product piques your interest, feel free to schedule a call. We'll add a Calendly link here. Pick a time, whatever works best for you, and see how we can help you. Um, Moving forward very quickly. So, without further ado, Michael, would you like to give a small introduction about yourself, SPE, right? How you're making the structure accessible for everyone?
Yeah, thank you, Farhan. Appreciate it. Yeah, very quickly, my background, I started out my career as an attorney and then got into solar via solar financing. We were working with a particular kind of financing in California called PACE financing. It's very popular, still is popular. We were helping at that point businesses and homeowners use different kinds of financing to finance and construct energy related improvements. So generally, people did solar. That was going really well, and we ultimately pivoted to just become a standard residential solar company. And so I ran a large installer in California and Texas, and I handled a lot of the operations and personally oversaw the construction of thousands of these same kind of residential assets that we currently transact on. Currently, what we do is we've used our background and our network and our resources over the past few years in solar and residential solar, and we set up tax equity partnerships and we have an assembly line of small residential projects that we flow into those tax equity partnerships that we set up. More background on tax equity generally. Historically, tax equity has been used to finance large commercial projects or utility scale projects. If you're driving through the desert in near Vegas, you'll see a huge solar farm, or you may see others in whatever state you're in. Those projects are almost all financed in part by tax equity. And the issue with those tax equity projects is that, number one, they take a very long time to develop, sometimes years, 4 or 5 years to develop these big solar projects or any other renewable energy project that might qualify for tax credits. So that's a problem, and it makes tax equity and those kinds of projects not really accessible to retail clients. And the other issue with those projects is the minimum investment size is really high. Sometimes that can be as high as 100 million plus, and that puts those kinds of investments out of reach for retail clients. Really, it's institutions, quasi-institutional money, big family offices, ultra high net worth individuals that can participate in those kinds of structures. So what we do is instead of having small commercial or large commercial or utility scale projects, we focus on small residential projects, and that gives us a few different advantages. The first is that the projects are, again, small. They're single family homes, and we can standardize them and drive down a lot of the diligence and engineering costs, engineering diligence costs related to those projects. All of our projects are the same in the most important ways. So that's really helpful. And the other great thing about these small projects is that instead of taking years to develop, sometimes usually they'll take weeks. So that also is a huge advantage over commercial projects.
And just to add one thing here, I think it's a really good point, Michael, that for someone who has who's a W-2 employee but has an S corp, right? They usually plan for things in a calendar year. So you have a tax liability that's going to occur this year, and you need to plan things ahead. And there's an IRS requirement that you have to buy new projects. You can't buy an existing project that's already been running, placed in service. So there's a constraint that there's a time clock, right? You need to execute something within a calendar year, and timing is a problem. So you're solving that by having smaller residential project that doesn't take a lot of time, right, or years to develop, right? You can get started relatively quickly, right? So you mitigate the risk of not having completed within the same calendar year, maybe taking a lot of time. And the second major constraint here is the purchase amount, right? If I don't have a tax appetite for even $10 million, I'm not going to put $10 million. If I'm solving for 500K, 600K, or 300K, 200K, whatever, I have a limited tax appetite. So that's what you are solving for, I guess.
Yeah. Yeah, sorry, just to jump in there. Yeah, exactly. On the project side, we make the projects small, we standardize them, and we can develop them quickly. And that brings the projects, makes them accessible to retail clients, and we bring that minimum investment size down. Depending on the investor's appetite, the client's appetite, we can size the appropriate number of projects to the client's appetite. On small deal size, I see Matthew. The projects will vary from $30,000 to $150,000. There's a huge range there, and so depending on your investment size, we will look at our pipeline and just pick out 1, 2, 5, 10, 20 projects, whatever amount of projects we need to use to size the projects to your appetite. The other, go ahead.
Sorry. No, I was going to say it's a good question. So right now, the minimum purchase amount that individuals can do by SPE is 150K, right? I think there's another question, a very good question from Matthew. What does a small mean in terms of single family homes? So I think that will be covered in the next slide when we'll talk about Solar Project 101. So I think for everybody's context, Michael, if you could explain in just layman terms, what is a project, right? Again, not a part of us solar farm somewhere in Nevada, right? What is essentially is, right? What are someone like Matthews buying it essentially?
Yeah, great question. Um, so the equipment that is installed for our projects is residential solar equipment, rooftop PV, solar panels, and batteries generally installed on the side of the house, energy storage. You've probably, everyone here has probably seen, the solar projects 1,000 times in, whatever state you live in. It is standard residential solar equipment that's being installed. The project is also wrapped in what's called a PPA, a power purchase agreement. This you may not be familiar with. So we have to step back. We do a lot of projects in California, and in California, homeowners will generally go solar in two ways. One is where they'll buy the solar equipment. They'll just pay a contractor to buy the equipment to install the solar panels or battery on the side of the house. And that homeowner will then own that system outright. They'll be able to claim tax benefits, or tax credits, I should say, on that solar system. That's one popular way to do that. Homeowners will come out of pocket, call it $40,000, and they'll just buy that equipment. They can also take out a loan from a solar financing company and finance the purchase of the solar project. That's one popular way to do it. Another very popular way to go solar is to engage in what's called a power purchase agreement. In this arrangement, a homeowner who maybe doesn't have $40,000 lying around, doesn't want to go and get a solar loan, they can engage with the solar company and say, look, solar company, we will allow you to put solar on the house. We're not going to put any money down. You'll fund the equipment, you'll construct the project. And as the homeowner, we will agree to buy all of the power that system produces. So in effect, the solar company then becomes their utility. They're delivering power to that home. The revenue, that agreement states contracted revenue under that PPA agreement over 20 to 30 years, depending on the terms of the PPA. But that's a very popular way to go solar in California and many other states. And that's what we do. So we own the system. The partnership owns the solar project. Again, it's standard residential solar equipment that I'm sure everyone here has seen just around in their neighborhood. And it's tied to a power purchase agreement where the homeowner is agreeing to buy power at a stipulated rate from us every month for the next few decades, essentially. And who is the customer? The customer is the homeowner. So we only work with homeowners, of course, and single family homes. We don't do multifamily or apartment buildings or condos. It's just single family homes. Nice, clean, small projects. Our average project size is about 7 kW, which is, call it 20, 25 panels, and 1 to 2 batteries that you would see on the side of the house. Tesla Powerwall, for example.
And one question would be, Michael, why would you pick California? I mean, why not pick maybe Midwest, or why not East Coast? What's the logic behind it?
Yeah, the logic is that the numbers need to make sense for the homeowner. So unfortunately for Californians, they pay the highest cost of energy in the US. We work a lot in PG&E territory, and we often see energy bills where the homeowner is paying 48 or 50 cents per kilowatt hour of energy. In a lot of the Midwest states, for the same energy, a homeowner is paying 10 cents per kilowatt hour, 11 cents per kilowatt hour. So it's dramatically more expensive in California. So that's why these kinds of arrangements are solar generally is very, very popular in California, but PPAs are especially popular in California as well, just because of their relative cost of energy.
Interesting. So to sum it up, for everybody's context, a PPA is a power purchase agreement in which, right, a homeowner doesn't have to pay anything, right, to go solar, right, and they would be able to save money on their electricity bill, meaningful savings, right off the bat from day one, right? So
That's right.
It's a big deal from. Sorry, go ahead.
Yeah. The takeaway here is if a homeowner engages in a PPA, they will see savings day one. If a homeowner buys the system and they just buy it with $40,000 cash, they will ultimately save money, but there'll be there'll be a break even point 4 or 5 years down the road before they'll start to save money. So for that reason, PPAs are also very attractive from the homeowner's perspective.
And it makes it a better deal for the partnership because you have a fixed customer, right? It's a different business, but you have a fixed customer who's paying for the electricity for extended period of time. So you're not shifting, taking the equipment, taking back somewhere else, right? You have one homeowner, and the incentives are aligned in a way that the delta is so big between utilities charging and what the system is gonna partnership is gonna charge them. It makes sense for them to pay. So that's why it sort of becomes a win-win deal for the partnership and for the homeowner. Let's move on to the next slide. Types of partnerships. So now, there are a lot of structures, Michael, out there that we are familiar with. There are asset purchases and lease backs. Now, if someone decide to go right, that they would like to take these tax incentives, they're in trusted investment tax credits, depreciation. There are a bunch of structures out there, right? And you and I are focusing on a flip partnership structure, but I think audience would love to understand why this particular structure, why is that attractive, what's the history behind it, right? How old that structure is, that something new, and again, the reasoning behind of picking this over some other structure.
Yeah. The primary reason why we've decided to go with partnership flips is that these structures have been pressure tested at the highest level. They've been around for decades, and there's probably been 200 $300 billion worth of funds that have flowed through partnership flips. So these structures are understood from a regulatory and accounting perspective. Everyone knows what's going on, and additionally, the IRS in a publication has come out and said, look, we will respect a partnership flip if it contains certain elements, which of course we adopt in our structures. So it's primarily because we're on very solid footing with partnership flips that we've adopted this as our default structure that we use to transact on these solar projects.
Got it. And I think there's another major element is the ROI, because that's what people look at when I look at these kind of transactions. And I think there's more juice that people can get out of flip partnerships relative to other structures that we have looked at. Obviously, we're going to walk everyone through the numbers, and it's going to become more clear. But just putting it out there. Now,
sorry, one more thing to say, Farhan, is a lot of our clients are investing in tax equity through tax equity structures for the first time, and that can be daunting, right? Someone who is maybe not familiar with solar,
Yep.
and if they're going to own solar projects, it may be a little intimidating to then take on that responsibility. And in a partnership flip structure, you're here with another partner, which is my side, and we are expert at developing, managing, and operating these assets. And so, a client that's maybe unfamiliar with solar or tax equity can rely on our expertise and have some assurances there, some protection that they're not going to be alone having to manage and operate these things.
That's helpful, Michael. Do you think it would be helpful to just kind of quickly walk through this slide, the client's entity, and how the partnership? Yep.
Yeah, sure thing. So very, very simple. And that is a client, the taxpayer, will generally form an LLC, and that LLC will become one of two partners in the partnership entity. There are only two partners. It'll be Solar Powered Equity, my side, solar developer, and then the client's entity. And the client will purchase interest in the tax equity partnership, as will the solar developer, my side. And again, we become the only two partners in that partnership entity.
That's a very good point. Just I think we've said this before, but to make it clear again, that this is not a fund, right? There aren't 20 people involved buying in a piece of a big solar farm, right? These are smaller residential projects, right? Single family homes, and the partnership, the umbrella level entity, let's call it, right, is going to be owned by the client's entity and you. That's it. You are the only two partners. Again, not a fund. Moving to the other slide. So how is it structured, right? This is a question we get, right? So the client set up an entity, you set up an entity, right? You both form an umbrella level entity, the partnership that owns these assets, right? And how do you distribute these ownership interests, right, in that umbrella level entity? And that's where I think we'll explain this, is that client's entity is going to own 99% interest in the partnership, right, for 6 years. So for 6 years, client is going to own 99% of it. Michael's SP is going to own a percent of it. After year six and year seven, the partnership is going to flip, hence called flip partnership, and client's entity will become a minority, right? From 5 to 20%, they'll own a minority ownership in these projects. And SPE will become a majority owner, will hold majority stake, 95 to 80% ownership in these projects. Now, the question that people may ask is, why is that particular structure, right? Why not 99% for 2 years or 3 years, and vice versa? So the answer here is that the credits and the depreciation vest over that period of time. You have tax credits and you have depreciations usually on federal level and state level, depending on the state you live in, vest over that period of time. And in order for you to claim those incentives as much as you can, you become a 99% owner in the project for over that period of time. When the partnership flips, so Michael is going to sit back for 6 years, right, with the 1% ownership, with a lot of patience. And then when the partnership is going to flip, right, there aren't going to be any tax incentives because whatever has been invested been allocated to your entity. It's just going to be cash flow that's going to be distributed between you and Michael's entity based on your ownership percentages. Incentives are aligned in a way that the client owns majority of the ownership in the projects for 6 years, takes all the tax incentives, and then Michael comes in and takes majority of the cash flow moving forward. Did I miss something, Mike?
No, that's great. I mean, the one of the things to say here is the reason we've adopted these percentages is it puts us in the safe harbor that we know the IRS will respect this partnership as a true partnership if we adopt these kinds of structures.
There's
The other thing also is the percentages align across all of the bundles of rights within the partnership, meaning there's allocation of. Oh, sorry.
sorry. Can you hear me? I think my internet is a bit spotty. Please continue. Sorry.
Yeah, sorry. So all of the everything is allocated according to these percentages. We keep things very simple from an accounting standpoint, where during the first 6 years, where the client owns 99% of the entity, they're allocated 99% of everything: tax credits, depreciation, free cash flow. And then when it flips again after year six, at the beginning of year seven, when the partnership flips, and again, there's no external trigger that needs to occur in order for that flip to happen. It just happens by virtue of the operating agreement that we signed in the partnership. So once that flips, then everyone is still allocated everything exactly according to the percentages of ownership in the partnership. We keep it very, very simple, for accounting purposes there.
That's very helpful. There's a very good question from Jeff. Right? Does it needs to be does the LLC needs to be in California, or it can be another state? Right? What are the trade-offs?
The partnership entity that will own the assets will have to be in the state in which the assets reside, right? So in California, if the solar projects that we generate will be, in California, the partnership entity will therefore have to be in California, registered in California to do business. However, the client's LLC does not need to be in California. It can be any other state. One of the advantages of partnership flips is that at the end of the year, the partnership will just issue a K1 to each partner in the partnership. And so we'll issue it to your LLC. So if you'd like to save some money and form an LLC not in California, where the cost to maintain that entity is pretty high, I think it's $800 a year, probably going to increase next year. You don't have to form your client LLC there. That can be in another state.
So just to clarify everyone, so the umbrella level entity, that the partnership, the LLC that's going to hold all these assets are going to be set up by SPE. So Michael's company is going to take care of that. You don't have to worry about it. Your entity that you'll be setting up yourself is something that you'd have to decide whether you want to pick California, whether you want to pick a state you reside in, or whether you're going to pick some other state where the setup cost is relatively lower. It doesn't have to be the state you live in. In the interest of time, Michael, very quickly, I think we should quickly go through the. I know we talked about the structure, but let's see how the numbers play out, right? How the actually partnership works when it comes to numbers. So, uh, very quickly,
Yeah.
would you walk us through?
Yeah, sure thing. So again, in simple terms here, client will size their investment into the tax equity partnership appropriately. Let's just call that $500,000 here for this illustration. Client will then purchase 99% of the partnership using that 500K. And then we will source and develop projects. And there'll be debt put on those projects that the partnership entity agrees to. And so the partnership will then purchase that, those projects for $1 million. It'll have a tax basis of $1 million. And so 99%, because the investing member owns 99% of the entity, we can allocate 99% of the tax benefits. So 99% of $1 million here, project basis, over to the investor. So for $500 in, there's additional tax benefits beyond the 500K that the client will be allocated.
Got it. I think this gonna help illustrate, what are the tax savings that they're looking at. So, what Michael mentioned is, again, you're contributing $500,000. There's a debt of another $500,000. So the value of the projects that you're buying is $1 million, right? That's how much the partnership is worth. And since you own 99% of the $1 million worth of partnership, you'll be entitled to 99% of the tax incentives, right? The perks and the depreciation and the cash flow, right? Everything based on your ownership percentage. So if you put these numbers, right, usually 40% of the project value, because Michael's project qualify for domestic content. So 40% of the project value is usually you would get in federal tax credits. It's called investment tax credits. They can directly offset your federal tax liability, can all be claimed in year one. There is also federal level depreciation, which usually on, if you buy an asset that's worth $1 million, it should be on the value of the asset. But the government says, well, you took tax credits. We're not going to let you at the same value of at the same project value. So they reduce the depreciation amount by half of the tax credit amount. So if the tax credits were 400,000, as you can see here, half of it is 200,000. So they minus 200,000 from $1 million. So you take depreciation, that's $800,000 worth of it. On state level, you don't get any credits. So on the state level, depending on the state you live in, but you would be able to claim depreciation on the full value of the asset, which is worth $1 million, right? Um, Moving forward to the next slide. So we have this real life case study that we would like to walk through and see how these numbers play out. So suppose we have someone who lives in California, makes $2 million worth in let's call it W-2 or business income. They are paying 37% on federal, they're paying 13.3% on the state level for California. They're going to owe $1 million in taxes, right? They have one thing that they can do is just sit tight, pay the tax bill. They have a clock on it, which is December 31st. Or, as per the last example, which we just walked you through, they could put 500K of that and put it into solar, right? A flip partnership. Now, in year one, they would be looking at around $415,000 worth of tax credit. That's a plus minus based on the project value. It's not usually 2x. So it's slightly up, but let's call it. It's $415,000 worth of credits that they would be looking at in year one. They'd be looking at around $123,000 worth of depreciation savings. Now, one thing to add here is when you apply your tax rate on the deduction amount, you can actually calculate savings. So hypothetically, if you get $1 million worth of depreciation and your tax rate is 37%, 370,000 is your actually savings, how much you saved in tax bill. And that's what the depreciation number here represents. So you're looking at 415 on tax credits, you're looking at 123 in year one, and you're looking at $28,000 worth of savings on California level against your California taxes, right? Not counting for the cash flow here, right? You're essentially net positive. If we sum these numbers up relative to what you have contributed, $500,000 into partnership, your year one is somewhere around 1.2x. So you're essentially 20% net positive in year one on a dollars that would have been lost to IRS. We'll come back to that. But next, on the next slide, what you're seeing is the total benefits of this. So you're looking at $415,000 worth of write-offs on tax credits on the federal level. You're looking at $307,000 worth of savings on a federal level through depreciation. Again, these are savings, not deduction, but applying a 37% tax rate. And you're looking at $139,000 worth of savings on California, right? There's another $50,000 worth of cash flow. So over the course of 6 years, right, when you are 99% owner, you're looking at around $923,000 worth of, majority of it is saving, right? Some of it is cash flow, which is de minimis, but majority of it is coming via tax savings on a dollars on a 500K that you would have lost to IRS, right? I usually get the question, what is the alternative? What if I park the money in S&P somewhere else, right? What is my ROI? So it's harder to calculate because, again, these are lost dollars. Michael, do you want to add something here?
Yeah, that's the big takeaway. The idea here is that you're taking money that you have to write that check no matter what. Come April or October, that check for taxes is going out no matter what. So, any savings on that is a huge positive. And if you can repurpose your tax liability earlier in the year, if you repurpose that to solar investments, then you can save 20% of what your net liability would be there. And you get all of that in year one, not subject to any of the cash flow, as nice as that is. Again, that's de minimis relative to the tax savings, the tax benefits that you'll get here. So that's the big takeaway. If I owe $600,000 in April, earlier in the previous year, I'll allocate 500K to these tax investments. By the time April comes around, I will have those tax benefits in hand to wipe out that 600K tax bill, is the way to think about it.
Yep. And it's helpful. And taking into consideration, we're not talking about the post-flip cash flow here, right? That you would be entitled to based on your ownership percentage. It's all tax savings against write-offs, not deductions. And the overall MOI could stand at 1.5, 1.8x, and you could take that money, deploy it again, right? There's a lot of room to play with, but eventually, right? Again, same thing that me and Mike has mentioned, that you're playing with the lost dollars, right? You're going to lose it anyway, right? The opportunity cost is paid to IRS, or you make, putting in $1, make 80 cents out of it over the process.
Yeah, there are very few investments that you can use pre-tax dollars to put to work for you. This is one of them.
There's a very good question from Jeff again. Jeff is asking, out of ITCs, right, depreciation on federal and state level, what can be carried forward, right? If someone doesn't have enough tax liability, or their expected income goes down significantly, and if they make the purchase, what you can carry forward.
Yeah, you can carry forward the ITCs, you can carry forward federal depreciation and state depreciation as well. All three, you can carry those forward.
And you can carry those forward for, I believe, 15 to 20 years. It's almost forever, right? For some reason, if your tax liability, again, goes down, right, you decide you want to put in a certain amount, but then the tax liabilities unexpectedly goes down, right? You can choose to carry forward it, right? You access depreciation and credits can be carried forward, and you can use them against your, next year income. And if again still goes down, you have a lot of room, right, to utilize them. You're not going to lose them, right? They're not going to go to waste. Even again, for some reason your tax liability goes down, or something, you can still hold on to them and can use them against your active income. Now, I mentioned one thing, which is active income. I think, Michael, we can spend a minute very quickly. I know we're running out of time, very quickly on material participation. I think we should make this clear that the material participation element is important here to use this against active income.
Yeah, that's right. So in order to use the tax benefits from the solar the partnership flip, if you're using them against the active income elsewhere, then you need to be active in the partnership. And the way to do it, if there are only two partners, which there are here in the flips, we can get into the rules probably in more detail in a separate call. But essentially, you'll just need to do 100 hours of activity in the business related to the solar assets. There are a number of ways that you can achieve that. We make it very easy to do that, but that's an important thing to call out in order to use the depreciation against active income elsewhere in that tax year.
Exactly, and I think this is a helpful call out, because again, if you would like to, which most of our clients do, use it against active income, they have to be active in solar, right? And I think when we'll cover the bonus depreciation that we're expecting to go 100%, I think that's going to be an interesting point to cover, right? Because we get that question, right? For how long do I need to be active? I need to be active for 30 years or 5 years and all that. So we'll come to that. So what is a process to go solar? The process is relatively quicker. I think we've covered this before as well in our other webinar, is that you're setting up an LLC, right? You are setting up a renewable energy business that goes and buys ownership in these projects, right? That partners up with the SPE. You set up an umbrella level entity. So you need to set up an entity. That's very important, right? You're making it a business case here, so you need to set up that entity. That entity goes and buys project. By buying projects, you'll be allocated 99% ownership. You'll get 99% of the incentives. It's going to be a pass-through entity, so everything is going to flow through you personally. Now, based on your material participation, if you are active, you would be able to use those incentives against active income when you're going to file your taxes in April, right, next year. And plus, there's an income stream tied to it. Again, it's de minimis. It's not the major sauce, but there is going to be income stream tied to it, which is going to be made, I believe, at the end of the year when the P&L is done. Michael?
Right. Yeah, that's right. Annually.
Got it. We'll come back to there are some interesting questions. We'll come back to that in a minute. We're just running out of time, so we'll make sure we'll cover the important slides that we wanted to cover today, and then we'll come back to questions. Yeah, it's a hot topic, Michael. We get this question a lot, right? Few weeks back, it was a different narrative out there. It was a different draft of the tax bill. Everyone was happy, or maybe some level of satisfaction. Where we are standing today, and where do you think the wind is blowing in terms of, are the tax credits are going to stay, or how should people think about it?
Yep, great. So as of June 11th, today, we currently don't know exactly what's going to get passed through the Senate. So the House proposed language a few weeks ago, initial language on the tax bill related to the credits, and then they revised that language and then passed it through the House essentially at midnight, and then passed it the next day, 8 hours later. And the language that's passed through the House phases out the credits, so the 48E credits. It phases that out 60 days after the enactment of the tax bill. Let me go back to the first bullet point and just say 25D credits are the credits that are available to homeowners that are claiming the tax credits on the systems that they own on their homes. That is not what we rely on. We're on Section 48 credits. These are commercially owned solar projects, which is what ours are. They're owned by a business. This is what, this is the partnership flip, that the partnership entity that owns the asset. So we operate in the 48 uh, 48E credit regime. Now, the credit phase outs. The current language phases out the 48 credits 60 days after the enactment of the tax bill. So if this language, which is very unfavorable to solar, if it gets passed through the Senate as is, then 60 days after that happens, then the tax credits would be no longer available unless uh, the projects are already under construction. We have been advancing a plan to basically safe harbor sufficient uh, equipment and projects to take us through the next 3 years. So if the worst happens, we'll have another 3 years to execute on these partnership flips with investors. And the economics of today will apply. So economics won't be diminished. We'll be able to continue doing business. Doors will be open. We'll be transacting for the next 3 years as is, even with the worst language. Now,
But
one good thing about the language is that bonus depreciation is almost certainly going to stay in that language and get approved by the Senate, which means you get, instead of having to wait for the full 5 years for all of the depreciation to be unlocked to you, you get to accelerate that into year one. So your return is larger in year one than it would currently be under the 40% bonus depreciation regime that we're in. Farhan, you had a comment.
yeah. So I was just gonna add one line here that the we talked about the numbers and the tax credits vest in year one, so you could claim all of them in year one. And with the bonus depreciation coming back to 100%, that means essentially you could take all the federal level depreciation in year one. What you'll be left with, depending on the state you live in, state level depreciation, right? So you could choose to go active, you could choose to go passive. So the point here is that most of your return, right? Most of the incentives are going to be coming in year one, right? So you could choose to go active. You're definitely going to be active in year one if you're writing off active income. But in from year 2 through 6, let's just say for state appreciation, you could choose to go active. You can choose to go passive. It's your call, right? If you think it's not worth your time to spending 100 hours for I don't know $5,000 worth of savings, you could choose to go passive. You could use it against any passive income that you may have. There's a strategic play here, but I think it's, in a grand scheme of things, it's very beneficial, right? From IRR standpoint and from the planning standpoint of material participation. So I we're getting a lot of questions. Michael, let's just
Yeah, let's
cover,
take some questions.
yeah, let's take some questions. So there's a question from Jeff. What are the most tasks that counts as 100 hours? How's the track reported? I'll give you my version, smaller version of it, and then I'll leave it to you, Michael, to add
Sure.
some color. There, so in terms of common tasks, it's not a black and white from IRS. They haven't released any guidelines saying that you could just take this timesheet and make sure you check all the boxes and make sure that you're there, right? And you're not required to submit anything to IRS at the end of the day, right? They're not asking you to upload, evidence of you went on a site visit and everything. So the point here is, so SP works with the national accounting firm. They have been through audits on this. They have done this with ultra high net worth individuals, right? Did more than $1 billion worth of transaction. As per them, you have to run it like a business, right? You would run any other business. So whatever you do has to be justified as a business. So they highly recommend site visits, going on conferences, learning about the industry, and watching. There are some courses that you could enroll in, and all that stuff. And at the end of the day, right, one thing that I would like to mention here is that I think a lot of people get confused by is that you're not active in a particular project. So if you're doing in a $500,000 with Michael and you own 20 projects, ownership in 20 projects, you're not active in 20 projects, right? You can't spend 2,000 hours. What if you own 40 projects? What, you'll be spending 4,000 hours? It becomes unrealistic. So you pool the time across different projects and you deem yourself active in the business. Valor has a online, we call it a virtual file cabinet, where you could actually log hours. You could actually put the time that you have spent on diligence, site visits, other stuff. We'll be happy to share access with you. There's no cost to it. Just feel free to create an account and we'll get you the access. Running out of time, there are a lot of good questions that would love to answer. Could quickly cover the last slide, Michael, which is timing, and then we'll move towards Q&A.
Yeah, just to wrap up, just really quickly to wrap up the last slide, I think the big takeaway here is that it where things currently stand is that the language is in the House and it's being revised. So what will ultimately get proposed and put to vote in the Senate is not what passed the House. There's going to be significant revisions to that. It looks like the language is going to be much more favorable to energy credits. So while we are prepared for the worst case scenario, it's very likely we're not in that world, and we're going to be happy in doing business for much longer than the 3 years. Big take.
And and just one very quick line, and I think this is what this slide is about. You can mitigate the risk, right? We don't have to rely on it, right? The incentives are there. It's not a law, right? You can do it today and mitigate that risk, right? Why rely on where the language sits? So Michael, I think that's where we are heading with people asking what is the right time, right? There's a political element to it, to incentive to do it earlier in the year, right? Do it right now. But future planning, how should someone think, what's the right time to do it and why do it now?
Yeah, apart from the urgency with the tax bill and just wanting to get your projects in, just generally the cost of waiting is that sometimes clients are thinking, well, I'll just keep my money in a high yielding savings account, something like that, for the rest of the year. And what they're doing is they're reducing their year one return. If you wait until the last minute, then the depreciation that you're able to unlock in year one gets reduced. There's two kinds of depreciation that happen in year one and through the first 6 years. The first is bonus depreciation and makers. And makers depreciation, the percentage of depreciation that you're able to unlock in year one depends on when that project was placed in service. So the earlier the project is placed in service, the more year one depreciation you can get. Granted, it's not that big of a difference, but it does make a difference. The other thing to note here is that the earlier these assets are constructed, the earlier they're going to be generating revenue for the partnership. And as the client that owns 99% of the partnership, you'll be allocated 99% of the free cash flow from the business. And so the earlier that asset is constructed, the more cash in year one that you'll receive. And then there's also just the on first come first serve. We have to place these projects into service in the calendar year. And so waiting until late in the year, puts a little uncertainty on whether those projects will actually be able to be constructed in time for you to claim the tax benefits in this year. So we're in June now. We're not going to run afoul of that anytime soon. But that's definitely something to keep in mind, because as we get into September, October, November, certainly December, the further we go along in the year, the more difficult it is, the more complicated it is to ensure that your projects are placed in service in this year.
Just to sum it up, and we'll move to Q&A very quickly, is that you're getting all the depreciation as long as you do it earlier in the year, right? More depreciation that you're holding on to. You are mitigating the risk of this whole political climate where the Senate is going to sit with the new tax bill and everything, so that you mitigate that risk. The other risk is the mechanical completion, right? And you can mitigate that risk by having the projects do it earlier in the year. They get completed relatively quickly, right? And they start generating cash flow quickly. And the last thing that I'll talk about is the material participation, right? The earlier you do it in the year, the more activities you'll have to perform towards material. So you mitigate that risk as well, rather than later in the year, right? It becomes very difficult. I've seen it. I see it every day, every year. So it becomes really difficult. So again, there's a lot of upside to do it earlier in the year rather than later in the year. I can't see of any upside other than you holding on to the money. Maybe sits in a high yield saving account, but other than that, I can't think of anything. I think, Michael, we should, unless you have something to say, I think we should move to Q&A. There are a couple of questions, good ones.
Yeah. Great. Yeah, some questions.
Yeah. So let's move on. Let's take this one first. Okay, so has the 100-hour strategy successfully passed an IRS audit in real life scenario? So none of our client has been audited, right? Michael, you could mention.
For partnerships generally, their rate of the likelihood of being audited is really low. And so none of our clients have been audited. Now, we work with a national accounting firm that has handled audits on this question, and they've passed all of them. And so if this is something that you want to get into the nitty gritty details, we're happy to set up a call with our firm and make you feel comfortable on this question.
There's another very good question from Kevin. First is, if your income is 100% capital gains, right, 1 million in income in California, do the numbers based on 21% Fed, 13% California, do the economics work at all, or the economics are the same? The short answer is that economics are not. So you're not going to get 1.8 MOIC, right? Your MOIC is going to be maybe around 1.5, somewhere around that, 1.4, 1.5. But your year one, and correct me if I'm wrong, depending on where the bonus sits, you're still going to be ahead in year one. You're going to be net positive, right? Your year over the course of 6 years, your MOIC is not going to be that higher in terms of savings because you are using a lower tax rate on federal level. You're using 21% relative to 37%. Michael, want to add
Yeah,
something?
yeah, that's exactly right. The numbers are better for you if you're offsetting ordinary income, but if it's capital gains, the numbers still work in year one. You're going to get above 1x on your return in year one, crucially, and over the 6 year period during the period, you'll still get a very, very attractive return.
Another question we've got, very good one. Do you need to be active participant for capital gain income? I mean, it's a question relatively for a CPA, but I'll give you my version, which is that depends where the capital gain is coming from. So suppose if it's coming from a sale of company stock that you receive as a part of your compensation, then it would be active. It's a portfolio income. You got to be active. If it's coming from a passive source, you are LP in a fund, right? Or maybe you sold a property where you were passive, you're not a real estate professional, then it would be considered probably passive, then you don't have to be active. So it boils down to, again, where the gain is coming from, the source of it. Going down the list, there's a very good question from Kelvin. Can you use the same LLC to do solar projects over multiple years, or do you need to set up a new one every year?
Yeah, the client LLC can be the same one every single year. We will set up different partnership entities because each entity ownership will be on a different flip timeline. But from the client's perspective, your client LLC can be the same one you use year in, year out.
Okay, another question from Kelvin. Can the client LLC be used in conjunction for other purposes, or does it have to be solely focused on the solar projects? Good question. Yeah.
Yeah, no, it can be used for other purposes as well. Just for clean, housekeeping purposes, it might be a good idea to have one LLC that just handles your solar investments. But I'm not aware of any rule that would prohibit you from using that LLC for other kinds of purposes.
Yeah, one thing I would like to mention here is that nothing prohibits for sure. I can't think of anything. I think it's one thing that Michael mentioned. One is for have a cleaner version. You have a renewable energy business. You're making it a business case, so you would have all your assets partnership through a one entity that you could use every year. That's one, right? The other is, depending on, what the other venture is that you're thinking about, you don't want anything coming from solar affect your other business. So it's a question of liability and everything. Again, lower risk, other things, but, for more, I would mitigate that risk by having separate entities. Obviously, that's not a recommendation advice. You could think through whatever you like, whether you want to set up multiple entities for other ventures or you want to keep all the things in a same LLC. It's your choice. Last question from Dustin. Can the revisions get worse on the tax bill? So Michael, that's in your wheelhouse.
Yeah. I don't see a scenario in which they get worse. I mean, possible, sure. Is it realistic? No. Everything that I see and read that's coming out of the Senate is more favorable to solar. So I would say I don't think that's a realistic possibility. Possible, but not realistic. I don't think.
And my settle. When are we, expecting for the Senate to vote on this?
Yeah, we should see proposed language no later than the first week of July, and that should be put to a vote shortly thereafter. So very, very soon, I think.
Very soon, but we still have 20 days and worst case scenario 60 days enactment period. So again, another push to do it earlier in the year. There. Thank you so much, everyone, for the time. Thank you so much, everyone, for joining. Happy to answer any questions over the email. Again, we'll drop our Calendly link, we'll drop our emails, we'll send over some material after the webinar that you can read through. Again, feel free to schedule a call with us if there is anything that you think that you would love to get clarity on, whether it's material participation, tax incentives, economics, everything. We're always happy to help you out. Again, a lot of it would make sense to do it earlier in the year. There's a lot of incentive, there's a lot of upside. I can't think of any downside. So again, we're here to help you out, happy to answer any questions. Again, thank you so much for your time. We'll have a few webinars coming in on IELTS on June 25th, and we have another one coming on oil and gas, which also solves for ordinary income, on July 9th. We'll send over the invites. Again, thank you so much for your time. Hope you enjoyed it. And feel free to reach out if you have any questions or if you would like to chat more. Thank you, everybody. Thank you, Michael.
Thank you.